Well, I want to officially welcome you to Chapter 5. You can tell, as we talked about yesterday, there's a lot of sections. A few of you asked about this fourth section. Just know the vocab side of this. We know what adjusting and closing entries are. We'll just talk about it when we get there. We won't have problems that are associated with it. This one is more just vocab as well, but these will actually have problems that we'll do with them. Okay. 3 weeks until our chapter test, so we'll do just fine. That's just a lot of new stuff for this chapter. I think what makes this chapter feel easy is that we are all consumers, flooding malls, flooding stores, flooding websites, buying stuff. The timing of it couldn't be better because it's Cyber Week right now. We're coming off of Black Friday, Shop Small Saturday, Cyber Monday, and now we just project into the holiday gift buying time. So you'll hear me reference, buying gifts a lot because it's December soon. We only as consumers can buy from retailers. So stores, whether it's a brick and mortar store like Willie's, you walk into Willie's, or whether it's an Amazon.com that you log in and shop with. Those are considered retailers. Who do retailers buy from? Wholesalers. What you need to know about a wholesaler is this can't happen. You and I just can't go walk into a wholesaler and say, I want to start buying. You typically have to have some form of a business ID, a business number. Typically wholesalers, not always, but you have to buy in bulk, typically. Like we at our school here, we get toilet paper probably from a wholesaler, and they're not buying 3 rolls at a time. It's probably 3-4 pallets at a time. Well, what would a general consumer do with 3 or 4 pallets of toilet paper? Okay. Your Under Armour shirts that you see at Town and Country, we go buy 1 from that retailer. Town and Country's probably buying 2 or 3 sets of all the sizes. And what would a consumer even be able to do with all of that? Does that make sense? What you see is a big price difference too. Retailers are going to jack the price up from what they bought it as from a wholesaler so they can make money. Okay. It just goes to show how much they mark it up during these like cyber deals. I think about totes. Totes drive me crazy on how expensive they are. You got to go buy a plastic tote. They're like $10. Well, I got some on Black Friday for $3. It just proves how much they mark them up. Okay, clothing, same thing. They're offering 50, 60, 75 off discounts. Well, obviously they're still making money at that discount. So it makes you kind of grumble as a consumer how much things are marked up, unless you're the retailer. But you know what? The retailers have a lot of money tied up in expenses, which we're going to get to here in just a minute. So do you understand the difference between a wholesaler, retailer, and how that impacts the consumer? Fabulous. So how is income measured? Well, what we've been doing chapters 1 through 4 is we're saying that sales or revenue, which I hope you know by now those 2 words go interchangeably, revenue minus expenses will hopefully result in a net income. So what you see here, revenue minus expenses equal net income or loss. You always hope that your revenue is larger than your expenses to involve a net income. Yes? What? Oh, yeah. Your worksheets will be ready when we need them. They're not ready yet. What you need to know, though, like if I sell something, there's way more to that story because it wasn't free for me, likely. Okay. When Town and Country gets Under Armour sweatshirts, they had to pay for those. And so there's this whole missing ingredient right here, which I'm about to show you. But even then, they have the lights on. They're paying their employees. They've advertised. There's running water. And so all of those operating expenses eat up their revenue as well. So that's kind of the simple measurement of income. Let's complicate it a little bit. I've got to get moved around here. My clicker's not working. That's why I'm standing over here by this arrow. So you take a look at all your money in, and Black Friday is called Black Friday because it's usually not a net loss that day. It's not in the red, it's in the black. Does that make sense? I don't know if you know that history behind Black Friday. There's other reasons, but Black Friday, typically you're making money. It's not a net loss kind of day. You take a look at all your sales minus what you're going to start referring to as COGS. I'm not talking Cogsworth on Beauty and the Beast, but I'm talking cost of goods sold. So in other words, we go back to that Under Armour sweatshirt, which, how much are they? 50, 60 bucks? What do you think it costs retailers to buy those from wholesalers? I have not that much. I have no idea how much, okay? I'll give you an example here in a minute, but what you need to know about COGS is the sweatshirt wasn't free, okay? They sell it for 50, 60 bucks, but it wasn't free. So they have to subtract out what it costs to get them, or the cost of goods that they sold. Cost of goods sold, again, is I use the acronym COGS. I think the book maybe even mentions it as COGS, is the total cost of merchandise sold during that period. That is going to equal what's called a gross profit. So you stop and say, okay, based on what we sold minus COGS, that's our gross profit. But then we have all these expenses like advertising, salaries and wages expense. We have utility expense. We have miscellaneous expense. The list goes on and on. So once we have our gross profit determined, then we have to say, well, what about all that, what's often referred to as overhead? What are your overhead expenses just because you do business? That then equals, hopefully, still a net income. Hopefully you were selling stuff at a large enough price tag that you can take the hit of COGS and your operating expenses to still have a net income. Now, a service business like a law firm isn't going to have a lot with COGS because they're selling a service that doesn't have a dollar amount attached to the COGS of it. Granted, they're going to probably have higher expenses because our lawyers paid a lot of money. Yeah, so that's where it kind of offsets. The act of getting your hair cut isn't a ton of cost of goods sold unless you're buying shampoo, conditioner, and hairspray when you're there. That would be COGS. Versus the act of getting your hair cut, there's not a lot of cost of goods sold, just the price of the stylist who's sitting in there getting paid to cut your hair. So do you understand service versus merchandising? Merchandising is stuff that's going in a shopping bag out the door or in your shopping cart and being shipped to you online. If I go back here a minute, when you buy in bulk, what does that usually do to your COGS? Brings it down. They often offer discounts. The more you buy, they're going to give you deals. You've got to have an infrastructure to be able to handle storing all that bulk. But a lot of times it's financially worth it. So let's stop, and is this in your notes? Perfect. Let's stop and just review. A simple income statement or income equation would be sales revenue minus expenses equals net income or net loss. If sales revenue is greater than an expense, you have a net income. You might say, this Mrs. Mars, we've been talking about that since chapter 1. What's the big news flash there? It's important to recognize the simple one before we get into the complex one. Complex, which is what we just did, is still sales revenue. What are we going to do first, though? If we're selling stuff, was the stuff free? Minus COGS. Cost of goods sold. If you want to put a little note to yourself in there that says stuff wasn't free. What's that going to equal? Sales revenue minus COGS equals what? Gross profit. Just kind of like gross pay on your paycheck. It's kind of gross that you don't get to keep all of that. Kind of same thing here. It's kind of gross that they don't get to keep it, like, ugh, gross. They don't get to keep all of it because gross profit minus what? Expenses. At that point, you hope, is still a net income and hopefully not a net loss. Let's put some numbers with this. Let's say I'm selling something for 10 bucks. On my shelf, it's $10. Trying to think what's really $10 in life. Let's go with a pair of socks, okay? And I originally paid only $1 for those socks. So I'm the retailer. I'm a retailer selling $10 socks that I originally bought from the wholesaler. For 10 bucks. What's my gross profit? Obviously. Do I get to keep that whole $9? Woo, 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 woo. No, because I've got things like the lights on. I've got my employees running around. I've paid for advertising so people even know that I sell socks. We've got operational bathrooms and like utilities that are going on. We probably have internet and cable available in our business. The list goes on and on and on. There's a whole bunch of operating expenses, like $5 worth. So what's my true money made on these socks? Maybe only $4. And if the bigwigs or the managers think that's not enough, if you're going to sell socks for 10 bucks, why are we only keeping $4 out of that? You might, from a management standpoint, step back and say, how can we increase our profitability here? Let's think of some ways. Let's think of some ways to make more money down here at our end. Woohoo, $4 in my pocket. Okay, what can we do? Okay, let's see. Am I running out of pen colors? I am. I could increase the price. Are our customers going to like that? Do we care? Well, we want happy customers. We also want money. Okay, what could we do on the COGS standpoint? Okay, maybe buy bulk. I've got to have more socks sitting around, but maybe that would reduce it by even 25 cents. What else could we do on COGS? Could we shop around with other vendors? Maybe other vendors bought in bulk and can sell cheaper to me. Vendors, wholesalers, use those interchangeably. Okay, well, both of those changes, if I crank my price up and somehow get a lower COGS, is that automatically going to give me a better gross profit? Yes. Now let's talk about expenses. What can we do from expenses? Not turn the lights on? No. Are we going to fire our employees because they're too expensive? No. Are we going to give them a wage reduction? No. Could we look at avenues of lessening our advertising? Do we all know that Town and Country sells socks? If you need athletic socks or just normal socks or even some fashion socks, they've got them. Could they reduce? Do they have to keep telling us about that? No. I think they can't completely lose their advertising there because actually their little flyers are pretty cute with their like the local people and their flyers. I kind of like them. Okay. What else could we do to reduce our expenses? We can't cut on our employees. We got to keep the lights on. Could we do some energy efficiency changes? Like maybe we get cheaper light bulbs that don't suck as much power. You know, like even in our school, how the lights go off when they're not being used. Granted, it costs money to put those systems in, but then that hopefully outweighs. So do you see from a management perspective, this is where they're trying to figure out how to get this almighty dollar up without making unhappy customers, without totally wiping out our expenses, because you need them to do business. That's what you'll hear if you're in a management course, or you are the one making the big decisions. So let's look at service versus merchandising. We've already kind of talked about it. So services like the haircut, the lawyer, the dentist. Merchandise is like Willie's, Town and Country, Just Us, Be Inspired. They're selling stuff versus service. Now you might say, well, there's services at Willie's. They provide dry cleaning. They provide like the act of making a birthday cake if you don't feel like making a birthday cake, but you're still buying the stuff, okay? The operating cycles are the same, meaning the accounting cycle is still the 9 steps. There's just way more to merchandising because you're touching more stuff. The stuff is coming to you somehow on a truck. The stuff needs a warehouse to be in. The stuff is handled by employees who you're paying. If I go have my car worked on and I say, send me the bill, they're going to send me the bill in the mail and they'll get their cash. If I'm selling stuff, I might get a bill from the vendor, and then I'm going to have to turn around and pay them, and then I'm going to sell the stuff to maybe a customer who wants a bill too. So there's AP, AR involved here versus just AR. I know it says just AR there, but if I don't pay for my stuff or my inventory to get to me, then I owe someone else. I owe an AP. So you might want to write that next to inventory. You're either going to pay cash for your stuff or you're going to owe someone else. So the operating cycle is overall the same. It's just that there's more hands in the cookie jar here on the merchandising stuff, which might increase the time of how long it takes to get all these people paid. Is this one in your notes? Okay, I didn't think so. Like I don't remember liking this slide either. What you need to know about inventory management, it's either a perpetual system or a periodic system. So let's talk about them more in depth. So think about inventory a minute. Do we know what inventory is? Inventory is an asset. It's the stuff that we COGS, or the cost of goods that we have available to sell to our customers. We expect Town and Country to have sweatshirts and shoes and mittens and gloves and paint and farm supplies when we go in there. And so all of it sitting on its shelves ready for us to buy, and all of it has a price tag of what they had to pay to buy to get it to us. If we are managing all of that stuff on what's called a perpetual system, that means that there are detailed records of the cost of each inventory at the purchase and then later at the sale. It's continuously showing what they have on hand, and it's determining COGS every time a sale occurs. So what you need to know about the perpetual system, it's very, very detailed. It's highly accurate, but it's also a lot of data. Like all that data needs to be stored somewhere. And likely it's got some kind of barcoding system that goes with it, or maybe an inventory number that goes with it to know what COGS was versus what we sold it for. When you go to a store and maybe your item that you want isn't in stock, like let's use Target as an example. Target, like if you want something and it's not there, what can a Target employee behind a desk typically do? Order it for you. They can tell you that, oh, we're the Alex store, but we don't have any, but I see the Fergus store has 2 of them, and the Wilmer store has 4 of them, and in St. Cloud there's 6 of them in that store. That is clearly a perpetual system because they know how much is on hand right now at any given time in any of their local stores. When you go check out, beep, and they're beeping the barcodes on that checkout system, likely that data is getting stored in some Target system going back to corporate to know, okay, I'm buying this $500 camera right now, and I'm, as the customer, paying Target $500 in some crazy system that they have for all their data management. Target knows exactly how much that cost to have that camera there. Does that make sense? Let's use Heartland as an example. Do you think Heartland Motor Company here in Morris knows exactly what they have on their lot at any given time? Yes, I would hope so. They're pretty expensive sitting there, okay? So if I go buy the $100,000 Corvette today, which isn't going to happen, but if I go buy that, do you think when I drive off the lot, they're using a perpetual system that knows that Corvette left today, and I paid $100,000 to the retailer? Do you think they know their COGS of what it costs to get it there? Absolutely. Does that make sense? It's all real time. It's right now. They know what they have in stock. They know what they paid for it. So when this $100,000 sale comes through, they know the COGS was whatever. Barcodes help this, but you need to know that the data that that barcode reads probably gets shot off to somewhere virtually. And those systems aren't very far off. You know, okay, so if I want the camera at Target and Alec doesn't have it, and they say, we'll call the Wilmer store will say, yep, I got 4 in stock. Yeah, we knew that because we can see your system. Cool. A periodic system then doesn't keep these detailed records. It's not to say they don't keep records. It's just that when the $100,000 Corvette goes off the lot, they don't, if they were using a periodic system, they'd be like, well, we might sell another one, and we might sell another one. Let's wait until the end of the fiscal period and figure out the cost of all those Corvettes that left our lot, instead of knowing every time. Again, the system is not wrong, it's just different. The cost of goods sold is only going to be determined by counting what's left at the end of the accounting period. In my Junk by Jenny business, this is what I use. I used to go this route, and it drove me nuts. Here's why. If I would go buy a $5 chair at Salvo or the thrift shop, I would put a number on it right when I'd get it home. Okay. And then I'd write in my little Excel file, I'd put my COGS, $5. And I always sell my chairs for $30, whether I put paint on them or not. But then I would be like, okay, well, what my COGS was $5, but then I've got all those expenses tied to it. Like I'm putting a little bit of paint on it. I used a little bit of sandpaper here. I'm adding some gel stain here. The part that was driving me crazy, and my accountant and I sat down and said, that system's not working, because if you remember, you know, my sale, which in this case on a chair for me is $30, minus COGS, which let's just say I got a $5 chair at Salvo, my gross on that chair, 25 bucks, right? No, because I've got all of those floating expenses, like, okay, I used a can of spray paint. Well, I used a can and a half. But then I'm not going to just throw the other half a can away because I didn't use it. So I was using partial supplies and supplies expensing them out, and it wasn't working. And it's like, well, part of that $30 or $25 gross profit was going towards my monthly blog fee and my advertising fee. And so I didn't like that concept. So together, my accountant and I decided this was better, because I can say, what did I start with? What did I add to, giving me how much I have to sell? Maybe I got a couple free chairs along the road. Or maybe this other person said, I'm getting rid of chairs, Jenny, do you just want them? But then maybe I found a really cool one that I paid 10 bucks for. So instead I say, here's my chair budget. Here's what I added, so what I have available for sale, minus what I actually sold, what's gone, that equals my cost of goods sold. And then instead of for every chair, like I use this can and a half of spray paint here, I used half a thing of stain over here, then instead I say, okay, overall, what did I spend on supplies all year? Because maybe that half can of spray paint went on a different project. Still used my 2 cans, it's just not versus every item, just holistically, how did I use my supplies? Again, this isn't wrong, it's just different. It's not nearly as detailed. It's just saying overall in 2016, what was my chair budget? And then what did I use in supplies to get those chairs sale ready? If I would move to more of a barcoding system, which I've thought about, like every chair would get a little barcode sticker right on it, then I could just scan it and like it would all go into, again, a system, which I'd need to have that system in place, that data system. I'm not ready to get there yet. I don't want to have a barcode system yet, because that, from an infrastructure standpoint, costs a lot of money to buy a barcode, to shoot out barcode stickers everywhere, and then to store that data somewhere. But on a $100,000 Corvette, yeah, they're probably going to want to know their COGS as soon as that thing drives out the door. So it's just the kind of business that it is really the importance. I want to show you a quick video. It looks like actually an accounting teacher. Look at, he calls it Whiteboard Wednesday. How creative. So I'm going to pause our video, and then I'll put this video on available on my website. I don't trust my smartboard. I'm going to use the mouse. Let's see what this. I think it'd be helpful just in your notes to just do a quick comparison. Is this there? Yes, it is. Okay. So are either systems right or wrong? No. It's just that you see, I just want to make sure I get my notes up here. You see this being more for small businesses. You see this for larger businesses. With a lot of inventory. Perpetual is continuously being updated. This has a beginning plus any purchases minus what's gone to equal an end. And then you kind of back into your inventory management what's left. When we purchase inventory here, so when we, the retailer, are buying it from the wholesaler, we say what we buy it for, what was our cost of goods sold. And then when we have a sale, we also think about cost of goods sold. Likely there's some kind of barcode with a really sophisticated like inventory management system. Like my Target example, Target knew exactly how many cameras were at all of the other stores because they have a sophisticated inventory management system. There are a lower, it lowers the risk of error because all of it's barcoded. This, of course, is basically free because there's not some barcode system plugging it into some inventory management system. It's just up to the small business owner to keep some kind of record of COGS. For me, I do that monthly. Every time I'm at Ace or Town & Country or Menards or Home Depot buying paint and sandpaper and just doing the supplies I need to do business, I keep a receipt, write it down. I go update my supplies every month. Same thing when I'm out picking. If I'm paying for those goods, I write a list down of what I bought, who I bought it from, how much I paid, the date. So then I go update my inventory or my COGS every month. And then at the end, I'm like, well, what's left? And then that's, of course, my ending inventory. With my supplies, I don't throw my paint away. I roll it kind of just like real permanent accounts. I roll them into the next fiscal period and keep using them. Did that help to hear it, see a video, and then just recap everything? Neither system's right or wrong. It's just the book will tend to go with more of the perpetual journalizing, and you'll see that Thursday, Friday. Tomorrow, when the sub is here, I want you to do questions 1 through 5 and brief exercise 5.1. They're vocab heavy. You're really going to have to understand the words to read them and answer the questions. So I'd like you to do those tomorrow. So I don't know if you need to write it down or I'll have it on my website, but questions 1 through 5 at the end of the chapter and then brief exercise 5.1. I don't think you shouldn't need a workbook for either of them, so you'll put all that in your notebook. Thursday then I'll go through the answers and then we'll get into actually journalizing the purchase of inventory so it's ready to sell.